Welcome to Trading with Stochastics Part 2, presented by DailyFX Education. In the first video, we started with the basics of the stochastics indicator. Stochastics measures the relative distance of the closing price and the current bar to the previous candles. Since it's a measure relative to other bars, the indicator is bound with values between 0 and 100. A pair is considered overbought when the value is above 80. Likewise, a pair is considered oversold when the stochastics value is below 20. However, we run into problems when there's a strong trending move, since prices can remain overbought or oversold for quite some time. So we added another filter to our trades. We only look for buy signals in an uptrend, or sell signals in a downtrend. What this means for stochastics is if the daily trend is up, then we look for stochastics to become oversold, and buy when the percentage K line crosses above the percentage D line. The opposite is true for a daily downtrend, where we filter our trades by looking solely for sell signals after the pair has become overbought. This gives an optimal entry price during strong trends. Additionally, we discussed divergence and how to spot it with stochastics. Divergence tells us the momentum is slowing. So when the stochastics crosses the signal line, we have an entry into the trade. We finished up the first video with a discussion of two most common types of stochastics: fast stochastics and slow stochastics. Slow stochastics is simply a moving average of fast stochastics, and it smooths out the line to more easily identify the signals. It's this reason why we recommend you use slow stochastics. In this video, we'll build on video 1's foundation. We will adhere to the premise of trading in the direction of the daily trend, but show another strategy of using stochastics in the direction of the trend. This strategy is called the stochastics pop. We'll review when to use it, where to enter, and how to exit the trade. Also, we'll further explore divergence, with examples of how to seek out divergence and use it to your advantage. The various input settings can greatly affect the stochastics reading you see, but certain input settings work best to your advantage. We'll finish with a third kind of indicator, the full stochastics. This is a less commonly used stochastic, and you'll see how its variations may provide a quicker signal to open a trade. We have a lot of ground to cover, so let's get going. In the first video, we provided a simple strategy to trade stochastics in overbought or oversold levels, but only in the direction of the daily trend. The good thing about that strategy is that you have one zone to focus on in your stochastics readings. Assume the pair we wish to trade is in a strong uptrend. Our simple stochastics crossover strategy looks for a buy signal when the stochastics crosses below the 20 line, which is the oversold zone. This provides an entry on a deep pullback within an uptrend. The strength of this strategy is the ability to focus on the oversold zone of stochastics. The downside to this strategy is that in an uptrend, stochastics will only briefly reach oversold levels, as you can see on this chart. Most of the time, stochastics gets nowhere near oversold levels. We don't always have to trade in the markets. Sometimes the best trade is no trade at all. However, if we can find trades using stochastics in more than one strategy, then we increase the likelihood of finding solid trading opportunities. The stochastics pop is a technique where the overbought situation is used in an uptrend to identify a breakout going long. Keep in mind, we're building on the concept of trading in the direction of the daily trend. When the daily trend is up, we look for a breakout to the upside, when stochastics reaches overbought levels. The pop comes in from when the stochastics indicator goes above the 70 to 80 level. Instead of reversing, the currency's momentum continues to rise. Stochastics pop is actually a misnomer, since the pop is in the price, not the indicator. The prices appear to pop like a kernel of corn at the right temperature once they reach certain levels on the stochastics indicator. The stochastics itself stays above 70 or 80, held there by the price moving up and staying high in its daily ranges. Stochastic pop signals a buy when a market is considered to be overbought by the majority of traders and is incapable of going any higher. The markets can remain overbought and oversold for prolonged periods of time. It may seem illogical or irrational for prices to keep moving higher while the stochastic is overbought. It may be equally illogical for prices to keep moving down when stochastics is oversold. But it's important not to fight the trend. There's no limit to how high prices can go, and prices could possibly go to zero, though unlikely. Stochastics pop allows the trader to take advantage of market momentum by buying when momentum is strong and selling when momentum is weak, in the expectation that the move will continue long enough to produce a profit. Often the greatest upside momentum over the shortest period of time occurs after a market is overbought or after a market is oversold. Let's get into the specifics of the stochastics pop trading rules. Using a 14, 3, and 3 slow stochastics indicator, a buy signal is triggered when percentage K is at 80% or higher at the end of the period. For the purpose of swing trading, use a 4-hour chart or greater. Once the stochastics indicator closes at 80% or higher, look to buy immediately at the next candle opening with a stop placed below the last swing low. Exit the trade for either a profit or loss when percentage K and percentage D lines cross one another. In this example, stochastics moves into the overbought area as indicated by crossing above the 80% reference line. A trader can enter a long Aussie dollar trade on the close of the candle that coincides with the percentage K and percentage D lines crossing above the 80% reference line. A stop is placed at the previous low. Notice how prices continue upwards as an increase in momentum appears to pop price a few candles later. This is an example of a stochastics pop buy and sell trade on the euro. Notice how the percentage K and percentage D lines both crossed over 80 and entered the overbought zone. Traders generally look for an opportunity to go short once these lines cross back below 80. In this case, a trader using the stochastics pop strategy enters long in the market at 145.35 while placing a protective stop loss 5 to 10 pips below the low of the previous candle, 141.85. The rationale is that there may be a strong burst of follow-through momentum once these lines move above the 80 reference line, as illustrated in the example below. A large candle accompanies this breakout, which can be interpreted as an additional confirmation. 8 candles later, percentage K crosses back below percentage D, which is our signal to exit the trade at 147. This trade closes out for over a 200 pip profit. In our sell example of stochastics pop, the euro is clearly in a short-term downtrend. Later, stochastics crosses into oversold territory. Many traders look at this as a sign to re-enter long. However, we enter short at market, getting filled at about 147.29 with a stop placed at 149.09, 5 pips above the high of the previous candle. The euro continues to drop to 143.32. The percentage K line crosses over the percentage D line, which is our trading signal to exit. We pocket a profit of around 392 pips. Here's an example of a short trade using the stochastics pop strategy on a 4-hour dollar-yen chart. Notice how the percentage K and percentage D lines both move below the horizontal 20 reference line. A trader enters short at market with a stop above the last swing high. In this case, we can take partial profits on the trade until either percentage D crosses back above percentage K and leave the remainder on until both lines cross back above the 20 reference line. The next strategy that we'll discuss is stochastics divergence. Back in the 1950s, George Lane, the creator of stochastics, stated that divergence is the only signal that should be used to enter a trade. Since then, the advent of powerful computers and the popularity of stochastics use has greatly expanded the way stochastics is used by traders. However, George Lane felt very strongly about stochastics divergence, and we would be remiss if we did not examine the application more deeply. Divergence is a key concept behind many signals for oscillators like stochastics. Divergence can serve as a warning that the trend is about to change or set up a buy or sell signal. There are two types of divergence, positive and negative, which we reviewed in the first video. What makes divergence in stochastics a powerful signal is the use of good money management techniques, such as a 1-to-2 risk-to-reward ratio. Money management is so essential to trading that we created a separate set of videos dedicated to money management. Now let me show you how tying stochastics divergence and money management together creates a strong combination. Let's say the pair is in an uptrend. You wait for a deep pullback and oversold levels on stochastics to appear so you can enter a long position. We get our signal here. As you learned in the first video, when entering a long position on oversold stochastics, we want to place our stop just below the recent swing low, so we place our stop here. We have a distance of 70 pips from our entry to our stop. So good money management means I need a take profit level of at least 140 pips. But after a brief move up, the price turns down and stops out the trade. Immediately, I begin to look for divergence. Since prices have already printed a lower low, I wait for stochastics to cross up at higher levels. A few bars later, stochastics crosses up again at a higher low from where I entered, and divergence appears, so I enter the trade. I enter on the open of the next candle, subsequent to the stochastics cross up, and place my stop just below the recent swing low again. In this instance, the stochastics crosses above the 20 line, which is okay. The backbone of this strategy is divergence in the indicator and my money management. In the second trade, the distance from my entry to my stop is 46 pips, so I look to profit at 92. The trade does move in my favor and hits my target level eventually. Notice how in this sequence of two trades, even though I won only 50% of my trades, I still ended with a net profit. The first trade lost 71 pips, and the second trade won 92 pips. So I gained 19 pips in this two-trade sequence. So if you're thinking of trading as a sequence of divergence trades in the direction of the trend, look at them in two-trade series. Oddly enough, this same pair came back later, and there's another stochastics entry signal here. After entering, we can place a stop below the recent swing low, which gives us a stop distance of 40 pips. We double that for our take profit level, and as you watch price action, you can see that prices just miss our take profit, and we get stopped out for a loss of 40 pips. Just like the previous example, divergence appears and we enter a long position on the next stochastics cross up here. Placing our stop just below the recent swing low means we have a stop distance of 30 pips, and we look to take profits up here at about 60 pips. A few hours later, the price moves in our direction and we take profit on our trade. This two-trade divergence sequence resulted in a 40 pip loss on the first trade, plus a 60 pip profit on the second, for a net gain of 20 pips. The important point to take away from this divergence strategy is that money management is crucial. By strictly using a 1-to-2 risk-to-reward ratio, these past four trades netted me 39 pips, and I let the market do all of the work for me. You may have noticed two different slow stochastics settings used throughout this video. In this next section, we'll discuss the various input values and which ones you might consider using in your trading. The first number in stochastics allows a trader to control the look-back period. This length determines how many bars or candlesticks are included in the indicator calculations. For example, a 14-period stochastics includes the most recent 14 bars in its calculation. Longer indicator lengths produce smoother indicator lines, and shorter indicator lengths produce more erratic indicator lines. Indicator lengths affect the number of buy and sell signals generated. You're welcome to try out these different input features, though our general recommendation is to use slow stochastics on either a 14, 3, and 3 setting or a 15, 5, and 5 setting. Shorter look-back periods produce more entry signals than long indicator lengths. For example, a short indicator length, such as 5 periods, might signal 15 trades per day, whereas a long indicator length, such as 15 periods, might only signal 6 trades per day. Shorter indicator look-back periods produce more entry and exit signals and require much smaller profit targets because trades have less time to reach its target before an exit signal is displayed. Notice on this chart how a 5, 3, and 3 slow stochastic has many more buy and sell crossover signals than the 14, 3, and 3. However, the longer indicator buy signals gave a larger profit target that was only matched by the shorter setting where the signals coincided. The number of periods used in the indicator can be varied according to the purpose for which the stochastics is used. If you use stochastics in combination with a trend indicator, like MACD, you may consider using smaller look-back and input values. This is because you may use the MACD to determine the direction of the trend, yet have sensitive inputs for stochastics for scalping or short-term trading purposes. Stochastics can easily stand on its own. If you plan to use the stochastics as your sole indicator at the bottom of the chart, then consider longer values, which can help smooth out and provide stronger signals. This means you can look for larger profit targets in your trading. There's one more feature available if you're looking for a more sensitive stochastics reading which generates more signals. There's a third indicator in the FXCM MarketScope charts called stochastics. We'll refer to it here as full stochastics. The full stochastics has 5 input parameters in its calculation. The first 3 values are the same as slow stochastics. The last 2 input variables allow you to change the calculation of the moving average. Where the fast and slow stochastics use simple moving averages, in full stochastics you can change the moving average calculation to an exponential moving average. By changing these last 2 variables from simple moving average to exponential moving average, it's creating a slow stochastic indicator which is slightly more reactive to the prices than that which you have on slow stochastics. That means full stochastics with the exponential moving average tends to oscillate closer to the 50 line. In general, the exponential moving average feature of stochastics generates more conservative signals, since it takes stronger price movement to throw the indicator into overbought or oversold levels. The difference between slow stochastics and full stochastics is difficult to see on shorter look-back periods. Therefore, a trader wants to employ this feature when using longer look-back periods. So there you have it, a couple of new strategies to use with stochastics in conjunction with what you learned in the first video. We hope you found this video helpful. We encourage you to attend a live webinar on trading with stochastics with one of our course instructors. Instructors will relate what you've learned to current market and trading conditions, where they'll also field live Q&A on the topic of trading with stochastics. Thanks for watching and good luck with your trading.